The S&P is breaking out to all-time highs, and this is leading to a problem. Traders are seeing certain sectors breaking out like utilities, but not understanding why. At the same time, leading technology sectors like the semiconductors cannot get above their 55 SMA, while other ones, such as IGV, are breaking out to all-time highs. So what gives? Why is demand for natural gas all of a sudden supposed to go up eightfold in the next 6 years for data centers? Shouldn't bonds have rallied after the record 50 basis point cut? Instead, they're selling off. At the same time, we're watching the NASDAQ completely underperform the S&P, so where's the leading sector? And for the recession talk, if we're going into one, why is XLY, consumer discretionary, hitting multi-year highs and new highs year to date? We've seen Warren Buffett buy Ulta, Starbucks and Nike hire new CEOs as if they're ramping up for something, sneaker companies hitting all-time highs, consumer companies like DoorDash and Instacart, which are high-end convenience stores, delivered right to your house. Why are they going up? Why is there such demand for a product if we're in a recession? And why is Microsoft buying 20 years of power? This and a lot more is going to be answered. Let's get to it. Hey everybody, welcome back. So we have a ton to go over. There's going to be a lot in here. You're going to want to go through this a couple times, and you're probably going to want to take some notes. But if we just look at the basics, you can just see what's going on with the SPY. You're hitting new highs. At the same time, if you look at the Qs, they're struggling a little bit. I'm going to clean up all my nonsense for a second. And we're just going to look at that weekly, which does not look as strong. So the SPY is leading. We know that. Now, if we do the simplest things, and we're going to go to a plain chart here, I'm going to drop this down to a 4-hour for us, and then I'm going to go back to a bear chart again. People always say, why do you say bear versus plain? I don't know why the words bother somebody so much, but I can start saying plain, and you can drop your comments on that as well. So what I want to just do is just show this 4-hour graph with a volume profile from the peak. And this will just give us a little bit of a technical indication of what's going on. Now, we all know that this is point of control. Point of control is very different than VWAP, and we're just going to explain this very quickly. There is VWAP. That is the volume weighted average price. If I took all this together and added it into a big ball, it's going to give me that line, and that line is going to be dynamic. The next part of this is point of control. This is where everybody owns the most at, and it usually creates what people refer to as a volume shelf. And then you have the low end of this range and the high end of this range, and you can see how we hit the high end of that range and stop. Now, what I think is significant about this, and I look at this, and I want to point this out to everybody, when I hit a range, it's not enough that I reject that range, it's the velocity in which I reject that range that I always pay attention to. For example, if I hit that valuation high level and it's like, oh my gosh, and everybody's panicked to get out, that's a much bigger deal like it is here, and then we fall apart, and then you can't hold point of control, and then you fall down, and then it's just a disaster, for lack of a better term, versus hitting here and selling down, and then kind of riding it a little bit, and then we're not able to take out that low. It's a very different sandwich to me, right? I guess we're going to use the word sandwich to describe things today. I'm kind of hungry at the time of recording this. So then we would look here and go, well, this time we hit it, and we didn't really fall apart, held in there. Now people tell me, there's more to it, and this is going to happen, that's going to happen. I'm not that smart. I can only trade what's actually happening, and what's happening is we're just building under this, which means, to me, we're getting rid of some of the supply, and that's why you're staying there, and there's a little bit of a gap there, and then maybe we fill that gap, and we usually do fill gaps, but this is what is actually happening, and I think that this is important for us to note. Now, we did see a lot happen on Friday, a lot, specifically even at the close where we saw names like Apple completely implode at the end of the day, and this is an important distinction. People are panicked and saying, oh, well, Apple's going to fall apart. Maybe it is, maybe it's not. But what we're seeing here is we're obviously seeing weak demand for Apple products. So does that mean we're seeing weak demand for AI products? It depends on who you ask and what they're doing with it. We'll leave it at that. I don't think that this should be something that we should overly concern ourselves with until we see how we play out on Monday. So I want to get that out there before we start, because you're going to have seen some kind of drop at the end of the day on a lot of these, right? You see that panic at the end. I'm not so sure that we need to be panicked, or we just saw someone have dumping, and maybe somebody had a margin call. We really don't know, and we'll find out on that Monday. But we're going to deal with the immediate now and then move our ways forward. I do think there's some big things out there that we need to talk about, and people need to look at things a little bit differently. Like, why is gold going higher? We're going to explain why this is actually happening. Like, why is gold breaking out here? Why are you seeing names like copper continuing to build here? Like there's a real methodology behind this, and there's a real reason that this is happening. You can see the W here on copper and how this is setting up nicely to possibly look at copper names. But at the same time, if we go and take a look at crude oil, And all we're doing is just seeing what's actually happening, right? So we're seeing crude oil inflate as well, and we have our line right here. And we're starting to see some of those bigger names lift as well in those sectors, such as Exxon. They're starting to bounce a little bit, getting back into that minutia level. Maybe we start heading back up here. We're going to see how that plays out. I think the most important thing for people to take a look at and try to understand from my perspective is what's really going on with the consumer. So in other words, we could spend a lot of time talking about interest rates, what he said, what he didn't say. There's definitely a whole video I could do on that, but I think there's more important to look at the theme. So one of the big misnomers in these videos is that I day trade, and I do, but it's very insignificant to what I really do, which is more swing trading and long-term trading. And I look for themes because when you find them, you can really sink your teeth into them and ride them for a very long period of time. So we're going to spend a lot of time on that today. You don't go up on consumer demand for discretionary stocks if you're going into a recession. It's really important to understand that the next 2 months are going to be critical to understanding what's going on with this economy. I have made my concessions for some period of time, or made my statement that I do not think that we are heading into one. I would argue that we were in one, and I would argue that this is a lot like 95. What I tend to do with these scenarios is I always want to look at my wants versus my needs and see how we're dealing with that. And I don't really have a clear pattern. In other words, I'm not really breaking up or down. I'm just floating sideways. So we really haven't made a decision here on what's more important, our wants or our needs yet, have we? And watch this, because when you start to see this kind of stuff, it's very clear. Like when you can see the pattern from here when we peaked on the market to how we flushed here to where you have that inverted head and shoulders and then you're breaking out. If you overlay this with the market, you'll see that this is pretty significant stuff. So you always really want to look at your wants versus your needs. Now, I think one of the most confusing things for people on the week is trying to understand what the heck happened here. In other words, what's going on with the Fed? What really is happening with bonds? And I think it's confusing for people. So if you take a look here at how we started the week, when you're really right around that 360, 362 heading into this, and then you're closing at a 372 on the 10-year, it's important to understand what's going on under the hood, but it's also important to understand how this is going to affect not only the market, monetary and fiscal policy, but how is it going to affect the different sectors? So let's get into it. Now, before we get into smart money, dumb money, how institutions are positioning themselves, I think there's a couple really core issues to go over. Number one is, why is this time so important? And this time's very important, but this is when you find out truly if we're going to have a recession or we're not going to have a recession. And that's what makes it special, for lack of a better. So here are the Fed cuts, and this is the zero line on the Fed cuts. And this is a graph that Goldman put out, and I think it does a really good job. It does a couple things. It shows you where you were, how the market acts before cut, and you can see that we fit right in perfectly with that right there. And then it just shows you through the cycles. And this is the median blended together when they avoid a recession after rate cuts. And this is if there is a recession. So what this means, and I think that this is the important part that I was really trying to get across to people. A lot of people just assume, oh, rate cuts bad. No, rate cuts can be really good, and we can do exceptional with them. Matter of fact, it lowers people's payments, and we have one of the fastest drops in history on mortgage rates ever. We're going to cover that a little bit later. But if we look at this particular section and we just drop this down, we can denote that we're going to have a better understanding in the next 2 months. And that puts you right around election time. We'll start to get some kind of movement in the next 60 days. So any data that comes out, any movement institutionally, or any movement that we see done by retail, we would think is suspect. But anything that we see institutionally might think or give us some glimmer that, hey, maybe they have a clue. So I want you to think about where we're at and why the next 2 months are so important right now. This is the market pricing before FOMC, after FOMC, and how Goldman sees the world. And I think it's kind of interesting because the one thing that we can say, if we take a look at September and the cuts and what the market was pricing before, what the market was pricing after, the market was not really pricing. And what you're seeing is a big change. And we'll talk about why. So in other words, the market after was pricing 50, right? And you could see it was getting worse and worse and worse. Now, before, they were expecting greater cuts going forward. And now they're expecting less cuts going forward. This is very important, really important to get, because a lot of people do not understand why utilities are not going up, why the bond market is not going up, why bonds are not rallying. This is why. This explains why instead of just looking at yield, you're going to want to look at lenders and borrowers. And it's really important to remember that statement right there, because that's what this is going to boil down to. It's going to boil down to lenders and borrowers more than anything. So Let's continue. But Goldman sees it a little differently. They're at that 25, 25, 25 over and over again. And they're saying 35, 40, 35, 35. So one of these obviously is going to be 50 or something like that. And then they're saying, okay, into May, it might get a little more goofy, but who knows, that may change along with it. But what's important again is how do they see the rest of the year playing out? Well, now they're at 25, 25. And the street has changed their mind because they're blending them together, understand why you're not at 50. So then if you take a look at what the market's really pricing in now, well, they changed their tune after this. So now you know what we're looking for over the next 2 months. And now you know what the street did with the information that they got from the FOMC. They changed the amount of rate cut. Despite what anybody says, this is where we were before, this is where we were after. This is what they were expecting, this is what happened, and this is how Goldman sees it, just a flat line. I thought this was interesting, so I just want to go through it. So from the first moment you have a rate cut, this is what REITs do, and it kind of gives you that range. Now, the majority of time, on average, after the first rate cut, REITs go up, but they go sideways for a period of time, probably for that 3 to 6 months, before they start the refinancing and everything. And I think you have to take that into account, right? It's not just like the rates hit and all of a sudden they get that. They have to go through the refinancing and then they have the cash flow, et cetera, et cetera. So I think looking at this, that you would start to say, okay, over the next 2 to 3 months, REITs are probably going to continue to go up despite the little pullbacks you might see. That little segue tells us what to expect from real estate investment trusts. It tells us where people are at, and it tells us why the next 2 months are so darn important. And to me, they really. And this is smart money, dumb money confidence. I've been asked a lot in comments to look at this, and I appreciate your comments. It helps me create content. I will be making some changes based upon it. I think when I start showing trading, I'm going to link just one night of just a trading vehicle and a trade that we did versus working it in on the Saturday videos. It seems to work a little bit better, keeping it all research and just keeping them separate. People seem to like that more, so that's what we're going to be doing. So if we take a look here at these two levels, and we know that smart money is blue, and we know that dumb money is red, and we refer to this as retail, not dumb, and we refer to this as institutions, not smart. And that allows us to look at this a little more objectively. And what we have here is just the 3-year. If we look at the spread, we're pretty much in tandem to an extent, but there's a couple little movements here where we have sold down from the peak clearly on what smart money institutions and what has retail done. Retail's hung in there. So retail's hanging in there, but institutions are selling. What we have to look at that is say, okay, well, how does that usually play out for us if we see that happen? And if we look at the year, we just kind of see where we are right here. And we're kind of pointing up a little bit, but looks like a little bit like we're about getting ready to roll there, just a little. Not that bad, but that's the drawing that we have. If we look here at the down slope, when we slope down, what happens? We go higher. Slopes down, goes higher. Why? Because institutions move like turtles and retail tends to move like a hare. They can't wait to get in, they're all giddy. And you can see those levels when we start turning on retail, what happens? You put in bottom because they got to get in and they got to get in by Tuesday. They can't wait. And when we see that, you can always see that they're just like, okay, well, we're going to sell to you. And they're scaling out why it's going up and retail's getting longer and longer as it's going up. Now, I think this one really covers it in general. What we have here is we have the bottoms and you're just looking at the year to date. And what I want to just focus on is the higher highs that always tend to mark what? A high. Does it? At least it'll say that we're slowing down if we start losing retail. And now we're looking at this and saying, okay, are we losing retail? I don't know. I don't know if retail's just going to stay up here, but what we are seeing is confusion. And I'll just refer to it as up. When was the last time we really just stayed stagnant for a month here with no real movement? You'd have to go back to July. And then what did we do? We lifted into it as it came down, right? And then we stayed stagnant here. And then we bought. And what happened? We went higher. So it's really a question of what is smart money going to do here, right? Is smart money going to come in here and start selling? And I do think that that's something that we need to pay attention to. And we're going to look at it from a different graph in a second here. But it's not the be all end all. It's the combination of both, okay? It really is, if we lose retail and institutions buy, well, then we're going to drop fast because we've lost retail and retail moves so fast, just like it did here, that institutions move like a turtle. So they're going to buy slower and just let retail panic, which is what they do. If retail just stays here and institutions start buying, you're not going to really have a choice but for this to go up. So I think it's best to look at this in tandem, but we are going to break out just smart money by itself. Now, this is just smart money confidence by itself, and you can break these out piece by piece. And I do think it's somewhat helpful to look at this and go, okay, what are we saying? Well, what we have is we have these peaks. And then when we peak, what tends to happen? Well, if we mark them off, we could say, well, when this peaks, we tend to put in some kind of bottom, right? Not all the time, but there's some kind of bottom. Is it all the time? It seems when we peak more than anything. And so the question really becomes, why is it doing that? Well, it depends on who's selling and how fast. So if that's a bottom and that's a peak, then what do we really want to do? Well, we really want them to get out, because if they get out, we tend to see that rally when they get out. I don't know that that's going to be the case here. I think you have a lot of confusion going over these rate cuts, and I think you have rotation. I think what we're going to see is I actually think we're going to rotate, and I actually think that they're going to get into different sectors. And if they start to buy and retail is buying, I don't really see how we're not going higher. Let me show you what's called the smart money. So in front of you is the smart money index. This is not something that I created. It's a sentiment trader. I have no affiliation with them. They just have a good product. And you can see right here from November, this thing's been on fire. And we all know what happened in November when the Fed said, hey, by the way, we're done raising rates. And since then, this thing's fire. But you have had pull. What I like about this and what I think is very important is if you go here and take a look at 2018, you have this level that you're not really there. You still haven't come to these all-time highs, but you're near all-time highs on this smart. And I think that's important when you realize what it is. Now, everybody that's been watching this channel knows I like people to understand what they're looking at. If you understand what you're looking at, you can actually interpret it your own way. And I think that's very significant. So the idea behind this indicator is popularized by Don Hayes. Existing mini variance, emotional trading takes place at the beginning of the trading day. We all know that. Traders react to overnight news and economic release. Smart money takes the day to evaluate price action and put together their market orders and watch the market close. Due to the assumed tendencies, we want to bet against the opening action, which is very true. Anyone that watches the market knows the first half hour is a little goofy. And then after the first half hour, you get the real move, whether that's up, then down, or whether that's down and then up. We always know that 10:30 or hour is really the first time we get the real move. It's usually, after 10:30, you start seeing where we're really going. And I think that's important. But they created this, and it makes a lot of sense. So what they do is they take out the first half hour, and then after they take out the first half hour, they add in the performance during the last hour. So let's say that smart money closed at 800, meaning you're flat. The first half hour gains 5. You ignore what happens till the last hour. Now, suppose the final hour lost 8 points. To get the smart money index, you take yesterday's number, which would just say it was 800, and the opening gain or loss. So you made 5 points. So if you make that 5 points, and then you're going to add the last hour 8 points. So today would be -5, -8, -13. So if you're up in the beginning of the day, you subtract, right? And if you follow me, and then if you were down the beginning of the day, you would add. So it's kind of interesting. They're contra trading retail, and then they're adding in institutions, which take place at the end of the day. Unlike most of our indicators, there's no hard and fast rule with this. There's no absolute or relative. Instead, we need to look at the action. When it's rising rapidly during decline, this means smart money is buying, and we should expect a bottom soon. This is really an important part of this. Smart money is buying, and we should expect a bottom soon. When it's rising rapidly during a decline, we should expect a bottom soon. Conversely, rapid falling during an uptrend means smart money is selling into rising prices. Head. Okay. Now, what we're doing with the smart money index is we're rocking and rolling on the 10-year. Right? We can all see that, right? Just exploding, pullbacks exploding. And if you look at these pullbacks, you'll note that they are in tandem with this. And we'll see this when we drill into like a 5, and we just kind of take a look at that. And if we mark these off, it gets pretty obvious here where you would see like, okay, well, dropped here. We kind of went a little slow there. If you see how it fell off here, you can kind of see that as well, right along there, and et cetera, et cetera, et cetera, right? Now, this is where it gets interesting. See how you rallied there, right? And do you remember what they said there? You go back and read it. If you're rallying, it's marking a bottom. So you're rallying as you're falling down. So we just pulled back pretty decent. And look at us rally right off. This is a really weird spot for institutions to be going crazy into the, and that's exactly what's happened. So we need to watch this over the week. Now, if we drill into this a little bit more and take it into like, let's say we'll do a year to date. If we take a look at this just a little bit more and mark off these levels, you can see these turns. And then what happens is do those levels and how they lift. And then you can just see from there how it just means a high, all-time high. And then you do it again. Now this is, again, I find this fascinating because to me, it's telling us you're setting. So you're hitting a higher high here, and you're not on the S&P yet. And then you hit a higher high here, and you're not on the S&P yet. If you were to overlay this, it's pretty accurate when you look at it over time. For example, we'll take this 3-year period. And if we take a look at here at how this was dropping on the smart money, all the way down to November to wherever. And at the same time, if we took from that level over, and we realized that we popped out over level, we popped over, but we were lower here than we were here. And then we look at that and realize realize that's all right. So if we look at, there is something to this. Now, when you undercut here, and then you undercut here, and when you're flipping that level right here, that's drawn awful, so we'll redraw that right here. When you're seeing these levels over, because that's hideous. Again, just gonna have to deal with the charm and not, but if you see us here, right, and then you go forward, you're like, oh, well, that makes sense, because now we have institutional buying. And then you just watch it follow. Now, what I see happening is a lot of nuance, right? One day we're up, one day we're down. That nuance is going away. It's just straight out buying into the close, okay? And it is somewhat surprising, say that, but that is what we're seeing. Straight out buying. So we're hitting higher highs on Smart Money Index, and we're near all-time highs on the Smart Money Index, and the S&P's not really following that. Now, we just did that on the SPY where we popped out, but is it really following what's been going on for the past 3 to 4 months? I would say no, it's not. And this is not something that is a day trading indicator. This is a long-term indicator, long to intermediate term. So you're looking months out, just like we did here, where you could see for months this developed, and then finally it kicked in with the false flag, and then you've flushed everybody, and then it just presented a nice opportunity. I wouldn't sleep on this. I'd pay very close attention because it tells us, even after the rate cut, that they are still buying stocks into the close. And we'll sit here and we will watch this next week. As always, please comment on this. I'm always interested in your opinion. Now, what does mortgage rates have to do with the economy? And obviously, it has a lot to do with consumer discretionary spending, more than we think. And this is something that I really didn't know. I didn't really get this to this level until I saw this data. And once you see it, it's one of those things you can't unsee, and you'll always remember it once you see how absolutely glaring this is. Again, this is not me, the sentiment trader, but it's something it's really worth going over. So on average, the 52-week net change chances of you being over 95 basis points or under 95 basis points in a year, or 17 or 15%. And what happens when that happens to the S&P is right. So you have a negative 2.4% return. And if it's below, you have a positive return. Now, what they're suggesting is this. It's the velocity in which way they drop. So if we take that into account, for example, and we just look at something like this and go, okay, well, from that 4 on, and we can see where that 4 started right here. And what they're doing, the average, so not where they are now, please get that. You have to average them all together. And if you look at that, that's pretty staggering number, right? From where you were, it takes you back to 79, 80. And then you would look here on average on that drop. And now in 52 weeks, based upon what the Fed just did, we are down 98 basis. So that would get us into this category right here. But you can look at this graph and see, it's not very often that you're going to get something. Now, you had something like this very similar in 95. And I've been talking about 95 for a pretty long period of time here, and how a lot of what we're seeing here is really reflective in what we're seeing here. I do believe that with AI and in regards to the internet, and I do think a lot of people are missing this. I don't think that they're fully getting what happened there with, if you think about it from a Netscape standpoint, if you guys even know what Netscape is, if the kids even know, versus to where you're at now, where people are looking at Chat GPT and go, okay, well, what do I do with this? And again, if you just look at where these rates were from here, and then you came across and you just took a line from there down, you get a good sense from that drop over. So if we took this again and just did it this way, and I'll circle it all in so you can see where I'm going, and you look at this space right here, it's a heck of a move. And it seems to me that we're in that same kind of range before we even get overheated, because we're going through this whole reinflate trade. So I do think there's some similarities. Now take a look at the data. Now, this is not really a common occurrence. And you can go back, they went all the way back here, and you kind of see, going through all this, how many times there were. And obviously you have the great financial crisis, you have before the pandemic, and then obviously you have 11 again when they did this. And we really are ripping when they're doing it. It's no small feat. It really isn't. Here's 95 when they're doing it, 98. You can see 01 when we hit the recession. Obviously that did not work. So if we do go into recession, clearly this data is just going to be on the flip side of that. Obviously, we all know that. But again, so here's our data set. And we only have 13 signals. I'd like 30. When we have 30, I have something that I can work with from a statistical significance standpoint. I can only show you what we have. But if we go through this and just go through the numbers and then look at the percentages, I think the most glaring thing for me, even when we get into the subsectors, is this 6 months later versus 12 months later. And the reason for that is when you look at 6 months later, you're thinking you're getting all the benefit of the cuts, and then all of a sudden you're starting to see some segue of not so much. And if you look at that and it said, okay, well, where do we see these changes? Well, you saw it like here in 89, and then it went negative, right? And then it got even worse here. So what you're doing is you're looking at the numbers, you're doing a comparative analysis. There are times when it just blew it out of the water, 6 months and then 6 months later. So as you analyze this and look at it, even 95, which I compare, you blew it out of the water. But you just want to understand that from my perspective, looking at this, I thought that was pretty staggering. If you look at a z-score and look up a z-score, the easiest way to think of a z-score is the form of standard deviation. And this is something that we can always get into later, but for our sake, I've done it once before, but I want you to understand this because it's very important. Z-score stands, what is the statistical significance of what you're looking at? When you get to something like a 3, it's someone likes to use the term absolutely glaring, and I think we're going to use that term. You need to pay attention to this. It's a big deal. Does it mean it always works? No. In this case, this signal has worked 85% of the time. A week later, you're here. But what I like about it is it built. It also fits right into that 2 months later where we just talked about, where you see that recession start kicking off, and then 3 months later, see how it dipped? And then you figure out, do we have the recession or do we not have the recession? And just look at that z-score and how this goes away right here, right? Like look at all the flux that you're going to deal with 2 months from now and how different it was. I mean, you're down here 15.8, and then from that 10 months later, look where you are. So when you see this kind of stuff, you want to pay attention to it because you can make money off. That's why you pay attention to it, because you're like, okay, well, this is good for the first couple weeks. Everyone's getting, feeling really good about themselves. And then we might hit that rough patch around November, which I do think you're going to see no matter what. Obviously, we have the election this year. But going forward from that, after that rough patch, this is a pretty good signal and one that I pay attention to. There's more on it. Now, sectors after the 30-year fixed mortgage drops by 95 basis points. What sectors are doing the best? Consumer discretionary. So this fits in exactly what we're seeing in the market right now, doesn't it? We're seeing all these people going out there and buying. And what are they buying? What are the majority of people out there really buying right now? Well, all of a sudden people are excited for their Lulu pants again. They're all excited for their Nike sneakers. So look at all the stocks that went up this past week. Lululemon, Ulta. All these companies, they're all getting new CEOs. We're seeing that fresh blood. It's my belief that we were actually close, if not in a recession, and that we actually we're coming out of it. But whether you believe that or not, that's okay. But look at the data yet again. You can see we kind of go sideways. And then if we look here, and we're not really that great 2 months later, are we? We're better off like a month into it if you look at those numbers over a month versus when you start looking at it 2 months later. It's because you're hitting that sweet spot. But when you come out on the other side of that 6 months later to a year later, it's pretty significant data. So yeah, you could see some of these and go, all right, financials, that makes sense, industrials. But what they're saying is up 26%. And why is it up so much? Well, if your mortgage payment was, let's say, 4% and now it's 3%, just to make the math simple, if you're paying 25% less on your mortgage, that's a big deal for the new people that are getting those mortgages. And they're going to use that to go buy widgets and things that they don't need. So that does spur this group, and it's not something I would sleep on. And as always, the devil's in the details. So if we look here, they break it down on a percentage basis. How many times is this sector positive or negative? 77, and they break them down that way. This stood out to me. 6 months later, every single time consumer discretionary was 6 months later from the date of the cut, or from that drop, apology. So that happened on the cut. That gets you there. 100%. It's a lot, man. It's a lot to process. I usually don't see that. I'll see like 92, but like every single time this has happened, 100% of the time, consumer discretionary is up. And again, what are we seeing? We're seeing that drop, aren't we? And you get that drop right into that second and third month. I wouldn't sleep on this. I'm always curious what you guys think of this data. I'm a big data junkie, so I'll look at stuff like, well, why is healthcare up? Well, you probably have more disposable income, so you're buying better healthcare. You're spending more money on your health, right? So that kind of makes sense. And energy, we're seeing that down, and I'm not really sure why we're seeing the energy sector down in these kinds of situations. Could it be because they're cutting rates because you are in some kind of recession? I don't know. But if we look here, that's one of the weakest, if not the considerable weakest areas, that 2 months. And then again, it's here a year later. Again, as always, I'm interested in your comments on this, but this is not something that I certainly would sleep on.
Now, this is really important for me, for people to get. And I'm just going to walk through this very simply. This is how I view the world. And
I think it's important because I think that this is where people get lost and this is where people run into trouble. Now, I do an onboarding call for everybody that joins the community. And the one thing that I find out that people are doing wrong, and you'll see where I'm leading, is that they go broad, they don't go deep. In other words, what they're doing is they're thinking that they're a jack of all trades, they're a master of none. So what tends to happen with people? The view of the world should be broken down into sections in regards to trading. So in other words, this would be day trading, swing trading, long-term trading, and then over here, you would have mergers and acquisitions, binary events like biotech, phase 1, phase 2. People will say that they're day trading, and then all of a sudden they'll allow that to turn into some kind of swing trade or long-term trade because this doom. And of course, then you always have the speculative nature. Now, this is just if you're trading common stock. Over that, then you also have the options or derivatives of swing trading, or this could be futures or something along this lines, where all of a sudden that swing trade turns into a longer-term trade. Whether or not it's something that's of speculative nature, and then whether or not it's a derivative of speculative nature, such as Intel or buying Intel calls, or buying US Steel, or buying SMMT. You'll see where I'm going with this. But here's what's really important about the majority of trading that I do, you'll see a lot of day trading. That's 25 to 35% of what I do. And this is what I refer to as hitting singles, making some money, getting out of the way. The majority of money that's made in the market by people is made in this area. And it's made by connecting the dots that we go over all the time, where I try to preach the technical side of this, where I say macro, which is what happens, who's affected by that on the fundamental side. And then of course you have here, which is the technical, which tells us when, right? So once again, when you look at our crazy little stool, we have the what happened, i.e. rates. And then after you have that side of it, you have who is most affected by it, by these macro decisions. And then when do we enter is what we're going to do with it, right? Now we're going to execute. Now the important part of all of this, from my stake, is that this is what people tend to do wrong. When they look at this market and they look at all the ways that it's broken down, they decide what they're going to do, mostly after the fact. But more importantly, they don't spend the time that they need to understand that there are times when you're going to want to do more of the day trading, right? You're going to want to focus more on day trading. And then there are times where you're going to take that day trading and it should only be this portion of it, right? And so these lines actually move on a percentage basis dependent upon how the index looks. Like if you're in what is referred to as a kangaroo market, and I understand I have more than one here, but it's easier to move around, then you might do more day trading. If you are in a market that has a very large footprint here, you might do more swing trading, okay? It is really important for you as an investor or trader, or however you wish to decide yourself or call yourself, that you don't say, I'm this, I'm that, right? No, you're somebody that trades and makes money, and you do it predicated upon the market and what the market has to offer. This is the flip side of that, and this is where people get lost. You don't try and do all of these at once. And this is what people do. I'm a day trader. I also bought these options. I'm a swing trader. I also bought these future contracts. I'm a long-term investor, but the 5-minute chart just gave me a sell signal, so I'm going to just blow out of my Apple. You have to define what it is before you even get in. What you want to do, and the people that I've seen in 25 years of doing this that are the most successful, and this is the number one thing I see when I do these onboarding calls with people that join the community. You need to pick where you're going to start and get so proficient at something such as swing trading, or so proficient at long-term leaps, whatever your thing is, get so proficient at it that no one could possibly mess with you on that thing. You want to day trade, zero-dated options? Go for it, knock it around, but become the best at it, or a level of such proficiency before you go on to the next thing. For me, it was not pulling money out of the market. It was always swing trading or long-term thesis, because I could scale into those positions and apply large amounts of capital over time. It was scalable to me. And I think this is a very important distinction that gets lost on people, and I wanted to spend just a few minutes explaining that before we get into our next topic. Now, on Friday, we all saw CEG jump, and we're going to talk about this in some detail as to why. Also, why it's probably not just nuclear, but why it's going to be some other areas such as. But nuclear leader jumps 20% after inking 20-year Microsoft deal. S&P component Constellation Energy announced Friday it plans to restart 3 Mile Island after signing a 2-decade-long contract for Microsoft to provide power to tech giants' data centers. CEG shares surge. There's a lot in this little line. Data centers, power, right? This is where all of this is going. So as I was explaining before, why you want to know where you are, But do I really want to be day trading something that just signed a 20-year agreement? Or do I want to understand what's going on under the hood and see if there's a way to make money a little bit longer term? Now, this is an excerpt from Investor's Business Daily. I'm trying to figure out where I got it from. But what's important about it are some key lines. Forget the firing back 3 Mile Island, and we could talk about that. 20-year contract. Not we need power right now, but 20-year contract going on. The company estimates the reactor will add 835 megawatts to the grid. This agreement is a major milestone, and listen to the words that Microsoft's using in order to get this done. Decarbonize the grid in support of our commitment to become compartment negative. So we are now seeing a shift in nuclear energy to now it is becoming green. Does that mean that this is going to be a major push by organizations to start looking at uranium? And I know a bunch of people in the room are going to go nuts right now when I say that because they've been telling me this for some time. This is where the puck is going, right? They're going to start looking at uranium and saying it's carbon negative. It doesn't matter what lipstick they put on a pig. This is what they want, so they're going to make it pretty, right? Please understand that. So they want the power. They're trying to figure out where they're going to get the power from. And so now they're going to preach that this is the way to go and this is the new, quote, green energy that makes sense because they can get access to it and they can get as much of it as they want. Whereas they really can't get all they need with solar, and we already know that. Microsoft continues to collaborate with energy providers to carbon-free energy sources to help meet grid's capacity and reliability needs. Thank God for that. The 3 Mile Island Unit 1 reactor located adjacent to Unit 2 reactor will shut down after 97, partial meltdown, accidents 3 Mile Island, Chernobyl, Fukushima. We know that these are real issues and they are things that are out there that we have to deal with. All these plants that closed, they're going to start firing this stuff back up, or they're going to have smaller units, but this is where we're going. And understanding where we're going, that helps us get in front of the curve. And you can see the power demand that's coming. And I know I get grumpy when I talk about it as they try to tell us what the new pretty thing is, but the bottom line is they just want power. That's what they're trying to get, power for their data center. And if you want to go look at this, go listen to Larry Ellison and what he said at Oracle World. But after being flat for 2015 and 19, we have seen data center power demand accelerate 21 to 23 and expects a 165 increase through the rest of the decade. Global data center electricity consumption, which includes AI, excludes crypto. All right, so what you're looking at here is the amount of power that's needed from where we're at to what their expectations are over that period of time, and data center power demand. So if we go here and say, okay, well, here's the estimation of where we're at, 600, and then you go out there and you're saying, well, within the next 5 years, we're looking at basically a double in power. This slide is by Goldman Sachs. This is what I'm talking about when I'm saying, if you want to day trade this stuff, that's great, and there's nothing wrong with that. But understanding why this stuff's going higher instead of saying, oh, I missed it. If you can actually look at what's going on and go, actually, this stuff's going to double, they're going to need double the power at a minimum that they have now. And Larry Ellison's speech actually alluded to the fact that it's actually probably significantly more than that. Data center workload demand nearly tripled between 15 and 19, but electricity consumption from data centers was flat. While the demand for workload tripled, the consumption was flat. Data center workload demand in millions, compute instances, data center power demand, LHS in TWH. And you can see how this is setting up. So it starts lifting. And what they're showing is the amount that's actually needed and how we're curving higher. And all you're doing is looking at where we are in 23. We haven't obviously finished 24 yet, so we don't know how that's going to play out. Now, the most important line of this slide to me, and we can all see traditional data center power intensity and how it's gone flat, right? So in other words, those efficiency gains that they were getting is what they're showing on this graph have all of a sudden started to shift. And now you're seeing those efficiency gains for the past 2 or 3 years, they're not there anymore. Now, what does this do for us and what does this mean? Well, I actually like the line the best. Decelerating efficiency gains have helped drive a pickup in power demand from data centers in recent years. So not only do you have current data centers that are now being not as efficient, you're going to have way more data centers. I think Ellison's predicting something like 10x the data centers in 10 years that they're going to have. It's a crazy amount. Now, we can all argue about NVIDIA, and we can argue about should it go up, should it go down, what's it going to do as far as day-to-day operations. We have seen new AI innovations increase max power consumption per server, but increase computing speed per server by an even greater level, representing a meaningful reduction in power intensity. So they are starting to see a reduction in power intensity by the compute speed. But in other words, if you're here and you're using the A100, the compute speed here, let's call it a 5, all right, which is what it is. But we're not going to get into all the nuance. All right, so then you jump from an A100, which the compute speed is a 5, and that takes you to an H100 chip, all right? And again, we don't have to be physics majors for this. All you have to do is look at the numbers and watch what they're doing. So the power required to go from a 5 to a 32 basically was less than double. And obviously we know 5 is 6x of 32, right? So we kind of get where they're going with this. Okay, from us to go from an H100 from a 10 to a 14 on the power side, which was obviously, let's say, is 35%. Okay, to do that, all right, we're going to be 2x on the compute speed. So the power is going to go up. Okay, that's going to be required, but the computation speed is going to be exponential in regards to that, which is actually good. But that's still going to put us at a huge deficit. AI servers in operation expected to grow sharply through 2030, even as revenues from AI server shipments decelerate. Okay, so server shipments from revenues are going to decelerate, okay, by 27 is when they're saying we're going to flatline. So here's where this gets fascinating. The operations expected to grow sharply in 2030, even as shipments of servers decelerate in 2027. So they're expecting the cycle of AI server shipments to slow in 27, right, to start like flatlining. So if we're looking at this hockey stick and how this is playing out, we would expect server growth to continue at least for another 2.5 years. And then on top of that, what they're telling you is even when that stops, the power that we're going to need is still going to accelerate. So the power demand is actually increasing even though they're shipping the servers less. And I think that's a very important concept to get, and maybe this will help people understand why people are so interested in the power movement. And what they're showing us here is that we see AI power demand growing rapidly, even as power use per server falls later in the decade. So they're saying that power per server needed, obviously they'll get more efficient and that's going to drop down. But as that happens, right, we're still going to need more power. Falls later in the decade due to mix shift and expected efficiencies. But you're still going to need significantly more power, which is what you're seeing in light blue here versus the power use per AI server. So the argument to the power side is like, oh, they'll just get more efficient. It doesn't matter. You're going to have significantly more out there than people think that they are. And this is where, to me, you have to pay attention because we're looking at this and saying, oh, it's going to be uranium or it's going to be these nuclear power plants. It's going to be energy. They're seeing a mix. And this is, again, not mine. This is Goldman. They put this thing together. But if you look right now and they're saying we see incremental data center power demand driving new natural gas demand. We can all go look at what happened to natural gas on Friday, which we're about to do. And we can see that you're at this 0.4 level here and they're saying 3.3. Well, it doesn't take a rocket science to figure out the exponential move that you're looking at here, right? You're looking at 8 times in 6 years is what they're saying for data center demand for natural gas. Do you think that that would drive natural gas prices up or down? Now, if you're in the community, you've already seen this before. I break everything down. I broke this down months ago into different categories. We have data centers, and then you can see the unregulated utilities, the independent power producers, commodities, regulation. I would strongly suggest that you do something like this where you start going through the names that are actually associated with this and start putting these pieces together. You may find different companies than I found. I like the way that I have this broken out, and it makes a lot of sense to me. I think it's very silly to think that uranium is not going higher over time right now. If you're starting to see these powers that be start to shift and say that this is now the new green energy, that's something that you want to pay attention to. Now, we can see the early movement here clearly and how it's acted, but what I would do is I'd start watching this commodity. Matter of fact, I'd start watching a lot of commodities. But if we know that they're going to need more data centers, like for example, then you know that these names are going to probably continue to push higher. So when you see things like DLR on Friday and you're watching these vol spikes that are coming in, it's not rocket science why this stuff's going to go higher. And you're going to need more data centers, right? So these are the two big data centers out there right now. And you can see how they're setting up and how they're... I personally look at these and think that this makes a tremendous amount of sense, that you're going to just need more of them. It doesn't really, it's not rocket science. So are these things that you'd want to day trade or possibly look at for longer periods of time? Now, when you start getting into whether you're looking at the unregulated utilities such as PEG and these names that are starting to break out, but you're starting to understand why these names are starting to break out and why they're setting up and why they saw these volume spikes, because people are starting to get it. See, what's going to happen here is you're going to have literally a power grab, where companies like CEG, for example, and we'll just go here and pull these up, but these are the independent power producers that I look at, CEG, VST, and NRG. And if you look at these guys and you look at what happened here on the volume side, the only day that you've ever had volume like this has been when you came out and you were public. And now you're breaking out completely. But what we're seeing is we're literally seeing a power grab where Microsoft is going to them and saying, we want all the power that you can possibly give us, to the point that Microsoft inked a deal to get 3 Mile Island back up and running. And they're saying, we want the power. We want it. So you're legitimately seeing what I would refer to as a power grab. Do you think that this is going to stop going up now? Now, it doesn't mean that you have to get in. Again, we have to go through the what, who, when of the stool. But when you start to look at these kinds of moves, okay, it starts making things pretty darn clear what's going on out there. Not only are you going to have a data center grab where you're only going to have so much land, you only have so much chips via AI. In other words, with AI, everybody wants NVIDIA chips. I strongly suggest that people look up Larry Ellison's speech at Oracle World and when he did Q&A. It is very clear that there is a gold rush. And as we look at the picks and the axes, there's only so many picks and there's so many axes. It's not like you can just commoditize NVIDIA chips. You can't. You can't commoditize power. It's not, you can't. There's not enough of it. And we just walk through slides to show that. So when you start to see these names like VST breaking out like this, and people saying, oh, I missed it. And then you realize that you're looking at a 20, 30 year cycle out for the next 7 years for power. How much did you miss? And then you would go back to the thing that I drew earlier when we started this conversation where I said, are you day trading, swing trading, or are you looking at long-term positions? This is what you have to start factoring in. This is how you make money, right? Because you start going, oh, I don't care what happens here because I know that they're going to need these services. None of this exists without this. And what Microsoft told you on Friday, if you're listening, is that there's going to be a power run. There's going to be a power grab, a legit power grab. I probably said that 5 times for a reason. So then you look at the next one, like NRG, and go, okay, well, who's coming after that? And then at the same time, it's not a coincidence that you're seeing something like natural gas actually spike on Monday. Like this wasn't a coincidence that you're seeing natural gas start to break out as people going and looking, going, wait a minute, we're going to need to see a run here. We're going to start seeing demand, right? And then you look at something like oil, and all of a sudden it becomes clear why it hit 150 new highs, which is the 3x or 2x ETF for natural gas, and how you're finally getting above that 55 right there. I use a 12, a 22, and a 55. You should use what you're comfortable with. And then if you walk through this, you can kind of go through some of the others and go, okay, well, are they going to need solar? Well, maybe, but they know solar is not going to do it. They know they need more power, okay? And so the shift that I showed you in those graphs showing that we're getting away from solar to an extent for this, and we're looking for other things. What are we looking for? Natural gas. And then we're going to say uranium is now what? Carbon negative if we use. See the language shift? See how they orchestrate the narrative? That's all you have to do is figure out how the narrative's changing, and then you can figure out where the money's going. Like, don't overthink it, right? That's what a lot of people will do here. Look at what they're doing, look at what's going on, and then figure out how you're going to profit from it. That's the whole purpose of watching these videos, is to figure that out. You would go into something like the specialty grid contractors and see if there's something we have to do there. Maybe. Which ones were up, which ones were down. Then we might want to drill into Mastech and see how they benefit from it. Why has Mastech been on a tear since September 9th? Okay, then you might look at something like power and try to figure out why is that breaking out and seeing all these volume spikes, right? So hopefully you can see where you're going with this. And then it's even the simple things that you have to look at. And I'll give you some examples of that. Where you're seeing like, oh, well, why is GEV going up? Okay, well, they are a power generation equipment provider. Well, that sounds like something we're going to need a lot of, doesn't it? And so you start connecting these dots. And we won't have to I'm not going to go through all of them, but what I'm trying to show you here is that when you're looking at things like this and you start trying to figure out how it's going to go, whether it's the electrical components or whether, you're looking at the, the back server solutions, you're going to have to cool this stuff too. And we know that, right? So then you start getting into those data center providers like VRT, which come out there and do data center solution, okay? You're going to need people like this. You're going to need someone that can put the cooling equipment in there. And that's why you're seeing names like TT or even other industrial space names like GE break out. And you're going back and you're even seeing names like IBM that are continuing to push because you have to do these huge build outs. It's funny, we have a guy in the room and he walked me through this like a year ago saying people don't understand how IBM is positioned to take advantage of this. And lo and behold, no one would have said, what the best AI play is going to be, IBM, which has basically doubled in a year. So the more time that you put into this, the more work and the more that you extrapolate out that data, right? And then you look at the data and then figure out who the real players are going to be, the more you can profit from it. But you need to understand your time frame. Okay? So if you're in these trades for like a day, that's great, but there might be a better way.